Now let's do another one and put it through undeposited funds. So let's imagine, let's add 2 more invoices, and we'll see the problem that arises when that happens. So let's make another invoice. I'm going to make it customer 2, let's say. Customer 2, we'll save it. And I'm just going to go boom. This happened on, let's say, the 8th. And we'll say this is service item 1 again. And let's just say that we had 3 of those this time for $300. That's going to increase accounts receivable. Other side go into revenue. Let's this time save and new, so I can enter another invoice, which will just simply be generically customer 3. Let's say customer 3, tab, save, and then we'll tab through this thing. And let's say that now this is going to be, once again, I'll just say service, sticking with our service item. Let's say that's just $100. Boom. And then I can say, all right, now this time I'm going to save and close it. Save and close, go into the balance sheet, scrolling up, run it to refresh it. Now in accounts receivable, we have 2 more invoices that have been entered. So we've got these 2 invoices, boom, boom. Let's go back. Let's go to the income statement. What happened? Donde? Where's my income statement? Let's run it again. Let's go from 010124 tab, 123125 tab, see it by year, and run it. All right, in 2000, there's our service income, $600 for the 2, the 3, and the 1. Okay, let's go back. So that has been recorded. Now let's go to the first tab. Now remember, you could wait till it clears the bank. What if this cleared the bank? Now what if both of those payments happened and they were done with a credit card, or they went through PayPal, or they went through Stripe, or we got cash payments, and we've got both of those payments, and then the credit card company, Stripe, or we, as we took the cash, deposited into the bank in a one lump sum of, what was it, $400. If I wait till that clears the bank and try to use the bank feeds to record it under the transactions tab, banking, when it clears the bank, it's gonna come through here as $400. The problem with that is if I tried to match it, it wouldn't be able to find the match automatically, because it would have to combine 2 invoices together in order to match out the deposit of $400 to the 2 invoices, which was $300 and $100. That's going to be a problem. Also, if it was a credit card, for example, that we received the payment from, there might be fees involved, which is totally going to mess things up, because you can't really record the fees when you're trying to match. So that matching system isn't going to work. We're going to have to record the receipt of the payment. And when we record the receipt of the payment, we probably want to put it into the clearing account so that we don't have this matching problem. In other words, I could have 2 received payments, and even though it's going to hit the bank as one lump sum, in which case I'd still have this matching problem. So what I want to do, I want to go into here, and I want to say, let's go into the sales tab, and let's say that we're going to receive the payments now. So let's go into the invoices, and let's say that we have our payments. So here's customer number 1. These I want to see not due yet. So now we've got customer 2. So let's say we receive the payment from customer number 2. We receive the payment, we get paid. Let's say it happens on the 9th. The payment method this time, we can imagine it's cash, but you can imagine a similar problem if it was a credit card or some other form of payment. We're going to get the payment, but it hasn't hit our checking account yet, is the problem. If it's cash, it's easy to visualize. We've got actually cash, but it isn't in our bank. If it's a credit card, they paid us with a credit card, but it's in the middle financial institution. It's not in our bank. If they paid us with PayPal, it's in the PayPal account, which we might track internally, or maybe we don't and wait till it hits our checking accounts. If it's in a Stripe account, it hasn't hit our bank yet. So that means that I'm not going to put it into the checking account. I'm going to put it into undeposited funds. So what's this going to do? It's a received payment form. it's still going to decrease the accounts receivable, but the other side's not going to hit the checking account yet. It's going to go into this clearing account. I'm going to save and close it. And before I look at that transaction, I'm going to do the same for this one, for customer 3. And we'll say we'll receive the payment. Let's say it's cash again. It's going into undeposited funds. Boom. And we will receive that one. Let's save and close it. And then let's go to the balance sheet and say what happened. Que pasó aquí ahora? We have then accounts receivable should be going down. So if I go into the accounts receivable, same things happening on this side as before, meaning we have a payment form matching out against the invoices. You can see them tying out nicely, each one to each one. I should be able to tick and tie them off. But instead of the other side going to the checking account, we put it into undeposited funds. As we can see here, let's go back. So instead of going to the checking account now, it went into this clearing account. Noting this clearing account is basically cash, a cash type of account because it represents money that we have, but it's just not in our checking account. You might say then, why isn't it under the bank accounts, which under normal financial reporting, this would be cash and cash equivalents up here. And the reason it's not up there is because QuickBooks, if QuickBooks put it up here, it would be acting as a checking account for QuickBooks, which means it would have a register and whatnot. And QuickBooks doesn't want it to have a register. So it needs to call it an other current asset type of account, even though it's a cash account. That's kind of problematic from a reporting standpoint, but it makes sense from that perspective. So when you're adding up cash in other words, tying out to something like your statement of cash flows, if there's something in undeposited funds, you have to add these two and undeposited funds, right? Which is down here. In any case, let's go into undeposited funds. So now we've got the $300 that are in undeposited funds. So that means that now, if I look at my flow chart, we have the invoice, we have undeposited funds. This is not acting as a deposit form in that it's not going into the checking account. It's going into the clearing account. And then we take it out of undeposited funds and put it into the checking account with a deposit form, which means that all increases to the checking account will basically be deposit forms if I use that method, which is nice. And it means that if these two amounts were grouped together because I physically deposited $400, not $300 and $100, or the credit card company, as the intermediary that collected the revenue on our behalf, then paid it to our checking account with $400 instead of $300 and $100, then that's how it would come through. And if the credit card posted something like a penalty or like a fee, I can possibly account for that as I recorded out of undeposited funds. All right, so let's go back on over. So then we would have the deposit that would need to be recorded. So let's go to the first tab and